Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Welcome back for another episode of the Property Nerds podcast. I'm your co-host, Arjun Paliwal, here with Jack Fouracre from Fouracre Financial, and we are talking interest rates today, Jack. And I know it's January. We're recording here for the February episode. This will come out on the 11th of February.
Yep.
Now, when it comes to the gamble, interest rates, up, down, what do you reckon?
For Feb, I think it'll stay the same.
Okay.
Yeah,
all right.
That's my gamble.
Your gamble's there.
Are you going to go with what CBA said, mate? They're going to reduce it? Or
Mate, my CBA logo tattooed on my chest from my days when I used to work there.
I reckon NAB's right with their May prediction. I reckon they'll be closer.
All right. I reckon we're not cutting in Feb.
There you go.
I reckon we're not cutting in Feb. And yeah, that's the gamble for me. Actually, you know what? We should replace the word gamble. Let's call it competition. Have you seen that?
I wish we disagreed though.
Yeah, I know,
It's
right? It
no
would have
fun.
been more drama. But have you seen that Michael Jordan documentary, The Last Dance?
Yeah.
And he goes, apologies for my American friends out there who are going to hear my American accent. He's like, so Michael, do you have a gambling problem? He's like, no, I don't have a gambling problem. I got a competition problem.
Yeah.
That's what we got. We got a competition problem, whether it's UFC, whether it's us talking UFC at home. By the way, not real bets. We're just chatting in the tables, chatting around the table at home, talking about who's going to win what fight and what interest rates are coming down when. But we both reckon there's a hold.
Yeah.
Does
I
that
think
mean
so.
we both reckon the drop's the next one after that?
I don't think so, man. I don't think so. I think May, if I was to have a good guess, I think April, May is a good, maybe for one there, yeah.
Yeah, I reckon my guess is Feb doesn't drop. The rate check after 100% dropping.
For March?
I mean, aren't they meeting up at a different cycle? I think they're meeting up at a different cycle now.
Oh, really?
Yeah, I think they don't meet like monthly. I could be wrong here.
See, I don't
But yeah.
pay attention to it as much now.
Yeah.
But when it was decreasing, it was like the whole office was like, oi, guess what day it is? Guess, now it's just like,
It's like a Melbourne Cup for,
yeah,
for
literally.
interest rates. Yeah, look, I reckon to stay. What I think they should do is they should cut in Feb. So if you want to know the answer of what I think they should do, they should cut in Feb. But I've just been disappointed by what their readings of the data have been so far. So I reckon it's a hold.
Yeah.
So, mate, talking of disappointment, how disappointing is it when it does cut and everyone thinks that they now can borrow $1 million more, but they can't?
Yeah. I mean,
it's not how it works, right?
look, I'm happy when they do cut it because I know there's a lot of people that need it.
Yes.
And there's people that are very, very close to moving forward or refinancing, but they're just not quite there. And for those people, it might tick them over, or they might already be in a position to do something.
Yeah.
But because of a rate decrease, it might prompt them to take action, which is the wrong thing to do. Like, you should, if you're being proactive about it, if you can do something now, you're going to benefit from the rate cut when it comes in.
Yeah.
Because there's going to be a lot of people that see a rate cut and go, oh, now's the time. All right. The smarter ones are doing it already.
Correct.
Knowing that the rate cut is coming in. But yeah, it works out to be like,
how much does it work out to be in terms of borrowing capacity difference?
not as much as you think.
like a 0.25%. What do you reckon?
Yeah, so per 500,000, you could bank on roughly 15,000 in borrowing, which is not that much, but it depends on your income as well, like your income bracket and negative gearing if there's any applied as well. So, but if you look at that over a larger portfolio, it's a weird one because if you've got like $2 million of debt, right, and that decrease gives you an extra 90K of borrowing power, that's just a cash out. Right. And now
that could fulfill the deposit.
That's
right?
just all you need, man. All you need. Because generally, if you can access the deposit and that's with a major bank, then you're going to go to a non-bank or third tier for the purchase anyway, which doesn't really matter. Like the rate cuts and borrowing power, it's already there. But to access the deposit, you don't want to really go to a third tier or non-bank to access a deposit. That unless you've got some, in the next 12 to 24 months, you've got some big plans with your income or you're just being really aggressive at that time, knowing that you can weather it.
Yeah.
But generally, you want to keep majority of your debt with a major, so that when you're accessing the equity, you're getting favorable rates, favorable terms, a lot less conditions, and then the purchase is done with a third tier or non-bank. So that if you've got a big portfolio and you get one rate decrease, it's pretty much another deposit for a property.
See, that's the thing that people don't recognize, right? Like I see many mortgage brokers out there downplay it. They go, oh, well, one rate cut's probably 3%. I get you. You're right on a percentage basis, 3% of borrowing capacity, but it's different per portfolio. If that's 3% against a whole portfolio of assets, that's a different story. And like you said, deposit comes out. And we're forgetting that there's also going to be people with trust lending that now might be close to neutral.
Yep.
And they can now get there.
Yep.
And if they get there, that's their accountant writing them a letter that they're now comfortable with.
Yep.
We also have people when once they get their deposit, like you said, you go to a smaller bank and you can unlock that next purchase. Another one, and this is one you also said, what about when people are sitting with many of those smaller banks and they just needed that 1 or 2 cuts to completely refinance their portfolio back to the bigger banks, save 0.5% to 1% on interest rates on all their lending, and then pull out deposits down the track to go back to smaller banks for more acquisitions.
That's right.
Like people underestimate the game changer it makes, which is why you shouldn't sit on the sidelines. You should get your portfolio reviewed because that's going to make a big difference, right? Now, when it comes to interest rates declining, Jack, what are your thoughts on when people go, well, I'm going to wait till it declines the whole percent so I can have maybe a lot more in borrowing capacity? How do you explain to them the situation that they may go into versus where they're at now with some fine tuning today?
Yeah. Like I said, the people that are just hearing the talk about interest rates going down, they're the smart ones. They're making the moves right now.
Yeah.
The ones that are going to wait for the first decrease, they're already missing the boat, kind of, right? If you wait a full year, right, all the crazies have jumped back in. All the ones that are just waiting for that sentiment to come back, they're already in. So, and a lot of people, we know this, a lot of people don't even know what they're sitting on. So people might be waiting for interest rates to come down, but right now they're in a position to do a lot and they're still going to benefit from the rate cut in the next month or the next 6 months. So yeah, like if you want to sit on the sidelines and do nothing, it's not the right way to do it.
Are you noticing some banks change things in anticipation for interest rates declining? Like example, whether it's their fixed rates, variable rates, whether it's their assessment rates, what are you seeing there?
So not the assessment rate, mainly in the fixed rate. So banks are begging you to fix your rates for 5 years. Trust me.
I wonder why.
And I think back to 2020 when the rates went down to 2%. And people were on they were 2 years into their 5-year fixed rate on 4.5%, 5%. And they're just like, what do I do, right? There's going to be a whole wave of people that hit that same trap in the next, already, but in the next 6 months where they think, oh, wait, they're going to offer 4.2% 5-year fixed. Oh, wow, like let me jump on that.
And then it comes down to 2, 3, 4, depending on the market.
Well, yeah, you never know, but don't fall into that trap. Like there's some specific cases where you would go fixed and it's generally on like really high LVR loans. And you so for example, if you had like a high LVR loan for an investment property and the variable rate was like 7.7 or 7.9 or something like that. And then the fixed, they're offering 6.8 for 1 year, fixed for 1 year. Of course you would take that.
And you know why that's a smart thing to do is even say if it's 2 years, I'll tell you why that's also smart. Because usually to move, you want that loan to deleverage. So if your loan's a 90% loan against a 700K place and call it a 630K loan, that property, you want it to grow as well, 10 to 15%. So then that 90% becomes an 80% loan. You have way more lenders that you can take it to. You can refinance at better rates.
Yeah.
And it might take 2 years of growth to do that. So if it takes 1 to 2 years of growth to do that, you might as well stay put and get a much better rate on the fixed if it's 1 to 2 years.
Depends what you buy. 100% depends what you buy.
You know what I mean? Oh, absolutely.
Yeah. And generally what we've seen with most of the clients that buy for InvestorKit, after a year, you've got that growth.
It makes a big change.
Oh, mate. And even if you have to, it rolls over from fixed to variable. The LVR is a lot better than what you purchased it at. And the banks know that as soon as someone rolls off a fixed, they're in the market to refinance. So generally they're pretty open to negotiation at that point, and it looks a lot better than what it would have been originally. So then you can just weather the variable for a little bit longer and, go back to an 80% loan.
Well, see, that's an example of bank versus broker. I know we've talked about it a lot, but if you're with a bank and you go to the bank for the loan, you're going to get a loan to value ratio and you're only going to get one valuation type.
Yeah.
Right? Now, whereas when they're talking to you and your team, it's like, okay, we went at a 90% loan. The interest rates are coming down or they're better. We can now review which banks offer us a refinance opportunity to get a better rate.
Yeah.
And then secondly, we can also conduct, say, between 3 to 5 different valuations and see what comes closest to our estimate.
Yeah.
And then with that valuation, you can take it to the bank to extract equity and buy another place. Like, these are the things that don't teach you at school, right? Multiple banks, multiple valuations, multiple assessments, multiple interest rate reviews, broker versus bank coming in again. Jack, that's key.
I think the main difference, like all the other stuff's obvious, but I think the difference in strategy that a broker is able to provide versus a bank is worlds apart. So if you look at someone's portfolio who has just been with their bank, because humans, they love having relationships with people and they're loyal, but if you're loyal to a fault, it's going to show, especially in your property portfolio. And I see a lot of people that stuck with their banker for so long and they said, oh, you can't do anything, and they did nothing. You're just leaving so much on the table. Like, I see so many banks, like when you deal directly with a bank, they'll purposely put you on a P&I loan.
Yeah.
They will purposely do that. And they'll talk you out of going interest only just so that you have more borrowing power with them, right? But whereas if you go with a broker, they know that, you'll go interest only with the major banks and the second tiers, and that will slightly reduce your borrowing power with those lenders. But then because you've got an interest only loan on your existing loans, it's going to open it up with the third tiers and non-banks more than you could ever imagine. Yeah. So, and it's better for your cash flow while you're holding the property, which is important for a lot of people. So
you don't want people to get what do they call it? Stockholm syndrome? Is that what they call it? Where you get you're falling in love with your captive and the person has got you under the bank and you're just sticking there. You don't know what's out there. And you don't know how you've been treated and you don't realize it. And I might have botched that example, but I mean, that's what it's reminding me.
Well, the way that they cross-securitize your mortgages with all your properties and they're all tied in with each other, it can cause a lot of nightmares. Like, we had a client who they needed to sell one of their properties and they didn't know their properties were cross-collateralized, and they got to the point where the bank wasn't going to release the security because there wasn't enough equity. And we had to quickly refinance both of them, and then so that the other one could settle and sell. And these bankers, they don't really, they don't have best interest duty. They're there to sell the product. They don't have to give you comparisons.
Well, people who aren't aware of cross security, what does that mean? What's an example?
So generally when you deal with a broker and you're going to access equity from your principal place of residence, you're going to create a separate equity loan against your principal place of residence to use that as a deposit.
Yeah. So let's just say, working example is $1 million home. It's worth that number. You got a $600K loan.
Yep.
You see 80% of $1 million is $800K, and you've got a $600K loan currently owing, and you decide to now take a $200K loan against that $1 million property, making your total loan $800. But when you log onto your banking, you're like, you're there, $600, $200.
Yeah.
You see two different. You can
That's
go,
right.
Hey, accountant, the $600 is for my home to live in. Can't claim the tax on it. It's where I'm there.
Yeah.
But then this $200, if I'm Jack, I'm going to buy a boat. No, I'm going to use this $200 and going to put towards an investment property.
That's a deposit, right? And then you would borrow money against the property. Say you're buying a property for $600, you got the $200K deposit that you've accessed equity loan from your owner OC. You borrow the remaining $400 or so to complete it, but then that $400 loan is secured against the investment. Now, what a major bank would love to do is...
So that's what we call non-cross security.
That's right.
Because you got two, property A, property B, and you got 3 loans.
That's right.
Home, deposit, investment.
Yeah. Now, what a major bank would love to do is take that investment property and don't give you an equity loan, but allow you to borrow the full amount of the investment property, $600K plus stamp duty. So you'd have 2 loans there, and you'd have your owner occupied loan of $600, and then you'd have the investment loan of $620, right? But that's the loan against that investment property is 105% loan to value ratio. The reason why they can do that is because they're using the equity from your owner occupied property, but they're cross securing it so that both properties are secured by the loans. And you can't just sell the investment property, because when you sell the investment property, you've got to close off the loan. So it's
I use an example where, like, it's, imagine you got your left and right shoe on, and instead of tying your laces with each other like properly, you tie the right lace on your left shoe to the left lace on your right shoe, and you do that. Now, sometimes you can get out of it. You pull the string in the middle, you revalue assets, you go to different banks, you've released the equity, and you're gravy. But then sometimes the pool doesn't work and you trip over, right? And that's kind of what happens in cross-security.
It's an unnecessary risk. A lot of times it will be fine, but it's an unnecessary risk, and it's a tool that the banks use to make it harder for you to leave.
Yeah, you can stay there longer. It's easier.
Yeah.
Now, I'll be the ex-banker that I am, and I'll talk to you about some pros about it.
Yeah.
But then there's way more cons. So I'm just spoiling the story already.
Give me one pro.
The pro is it's so easy. When I go to my tax time and I tell my accountant, this one loan is for that property. Chill.
Yeah.
And then the accountant doesn't go, I saw you refinance between this bank to that bank. What did you use that money for?
Yeah.
How did you close that down? Why is that loan number there? Can you give me a CSV of this one? And like, we're 17 properties deep. We change banks and we close off a loan. I go to the bank branches still. So I'm that, OG that goes to bank branches, keeps the game alive there in the branches. No online stuff for me, because I need to go to all these closed accounts, the stuff that's not showing, the online that's not there because I refinance. Only pro. Other than that, not worth it. And if I've got one pro and you've got 10 cons, I think we know who wins. Do you know what I mean?
Do people still go to banks to get loans? Like, you see these new branches that are popping up. They don't even have like business bankers in there. They've just got like a teller, couple ATMs,
look, they're a lot more
offices.
Optimized, but they still pump it. They still get stuff. I mean, like, I think the biggest advantage why certain banks still crush it with loans, like CBA mainly, speed. Like, I've seen some of them get like, hey, you're overseas, your bank wants you to sign guarantor docs for a trust. We're 5 days away from settlement. We'll get you approved, digitally signed, ready to go, have this structured and settled in 5 days. So I think it's like those, like, speed, and when someone has good speed and a good experience, they go, you're my guy. You're my gal. I want to be with you forever. But look, bank broker aside, I think the interest rates thing, coming back to that, I will say one thing though. My final thing to say on that is this. Yes, it makes sense to buy before interest rates come down. Yes, it makes sense to not wait and buy when you can. But let's just say you can't for some reason. Or you don't happen to have that happen. Don't get into FOMO stuff. At the end of the day, we've been buying properties for clients now for over 6 years. And during that 6-year time, we've seen interest rates fall like crazy. Interest rates rise. The pandemic, recessions, crazy amounts of stimulus, no one touching regional markets to everyone looking at markets all over Australia. No one wanting to go beyond the backyard to now everyone being borderless investors. No one saying they're data-driven to now everyone saying they're data-driven. Like, we've seen it all in the 6 years. And so during that 6 years, here's one thing I always tell clients. Every single year, we have to survey the markets, read the tea leaves, and buy a property that fits your portfolio that's going to outperform the market. Every single year during the last, 2014, I think I started my portfolio, 10 years then. Every single year during the last 10 years, I picked up a property for myself, which means this. There is no stress on macro conditions that happen or don't happen. At the end of the day, there is a market somewhere, and we've released a chart on this, that will grow well in any condition, in every year, in any year, or will be a buyer's market in any year, every year, and we can spot that. That's our X factor. And we can take that and fit it into what you have tailored to you. So that means as you're on this journey, take your time. Well, like, if it happens, it happens. If it doesn't, it doesn't. And this is the difference between professional buying. When you're not buying with a professional, you don't have a tailored strategy. You don't have a plan that's tailored to what type of property you'll buy. You don't have a property that's selected in the right cycle at the right time that meets due diligence criteria, that you're not rushing because interest rates are falling. Let me go buy on a main road. We've seen that happen, and you won't overpay on an asset. And so when you've got all that criteria, it means any given time of the year, we'll find something that works. If interest rates drop 0.5% and you still haven't bought yet, we'll still find something that works. So the key there is that when you have professional buying, when you have professional portfolio and understanding of that finance review with the buying, you're unstoppable. And that's what's made me go every year when I can, if I can, I'll buy. And it's happened to date. So that's my biggest tip and final send-off to people. Firstly, is that yes, if you can, go for it. And if you can't, or you haven't been able to, something's come up, or you can, but you just haven't gotten to it yet, don't stress. There should be a good market every year that suits your portfolio. So that's my final thoughts on interest rates.
Yeah, I think what you said about FOMO is pretty true, because I see a lot of people that probably shouldn't try to push that next one right away, and they probably should wait. And people fall into that trap of not doing that and buying a suboptimal property, and then it biting them over the next couple of years. So yeah, I think definitely there are a lot of people that can do something, just haven't, but there's people that are trying to do too much as well.
100%. And we always say, is it a strategy fit? Can you borrow for it? Do you have the right buffer? Can you execute it on your own or with a team around you? And if these are the ticks, makes sense. If it doesn't make sense. So, Jack, we'll see what the gamble comes up, and the competition that we have between us comes up, a decline or the stay. We'll be both wrong or both right. It's either that, right? So
true.
We're winning or losing together. But mate, that's it from me. And I guess I wanted to say, on the note of interest rates though and review, how can people get in touch with you and your team? Because I think we've talked a lot about portfolio reviews that people didn't know about. And I'd encourage people to actually start getting to know about what's happening.
For sure. So just head to fouracrefinancial.com.au and you can book a link directly there.
Awesome. And if you'd like to have a chat with us at InvestorKit, it's investorkit.com.au for a free consultation, and we'll go through your goals, understand what you're looking to get out of property investing, and take it from there. That's it, Jackie. Catch you on the next episode. See ya.
Game over.